Why don't stock market experts ever read novels? Because the only numbers in them are page numbers. Here's another one for you. Why did the Scarecrow become a successful investor? Because he was outstanding in his field. Today we're diving into the top 10 things you can invest in to make money in 2025. Whether you're a seasoned investor or just starting out, these tips will help you grow your wealth. Investing is a long game. It's about making smart decisions today that will pay off years down the line. So buckle up, grab your notepad, and get ready to learn about the top 10 investments to make money in 2025. Let's get started. All right, let's kick things off with the stock market. Now, I know what you might be thinking. Stocks? Isn't that risky? And yeah, you're not wrong, there's always some risk involved. But here's the thing. Historically, the stock market has delivered some of the best returns over the long haul. We're talking about the potential to grow your money significantly faster than you ever could with a traditional savings account. Think of it like this. When you buy stock in a company, you're essentially buying a small piece of that company, and as that company grows and becomes more profitable, the value of your shares goes up too. Now, I'm not saying you should go all in on one single stock. Diversification is key here. Instead of putting all your eggs in one basket, spread your investments across different companies, different industries, even different countries. This way, if one investment takes a hit, your entire portfolio won't go down with it. The key to success in the stock market is to do your research, invest for the long term, and don't panic sell when things get volatile. So stay the course, be patient, and watch your wealth grow. And remember, the stock market is like a roller coaster. It's only scary if you jump off in the middle of the ride. Let's face it, they're not making any more land, right? That's why real estate has always been considered a solid investment. And no, you don't need to be a millionaire to get started. You could buy a rental property and become a landlord, collecting rent checks every month. Or if you're not ready to be a handyman, you could invest in REITs, which are like mutual funds for real estate. These allow you to invest in a diversified portfolio of properties without having to deal with tenants or toilets. Now, real estate isn't without its risks. Property values can fluctuate, tenants can be a pain, and there are always maintenance costs to consider. But when done right, real estate can provide a steady stream of passive income and long-term appreciation. Plus, there's something tangible about owning a piece of property. It's a physical asset you can see and touch. So whether you're looking for your next rental property or considering adding some REITs to your portfolio, real estate is definitely worth a look. And remember, in real estate, the three most important things are location, location, and location. Let's be real. Not everyone has the time or desire to research individual stocks and bonds. That's where mutual funds come in. These are essentially baskets of stocks or bonds managed by professional fund managers. Think of it like outsourcing your investment decisions to the experts. The beauty of mutual funds is that they offer instant diversification. Instead of buying shares in just one company, you're investing in a fund that holds shares in dozens, if not hundreds, of different companies. This spreads your risk and increases your chances of seeing positive returns. Plus, with a mutual fund, you don't need to be glued to your computer screen watching the market every second of the day. The fund manager takes care of all the buying and selling, rebalancing the portfolio as needed to maximize returns. So if you're looking for a hands-off way to invest in the stock market, mutual funds are definitely worth considering. And hey, why did the mutual fund manager bring a ladder to work? Because they wanted to reach new heights in their investments. All right, let's tone down the risk a bit and talk about bonds. Now, bonds might not be as exciting as stocks, but they play a crucial role in a well-diversified portfolio. Think of them as the responsible older sibling to the stock market's wild child. Essentially, when you buy a bond, you're lending money to a government or corporation. In return, they promise to pay you back the principal amount plus interest over a set period of time. Bonds are generally considered less risky than stocks because they offer a fixed rate of return. You know exactly how much interest you're going to earn and when you're going to get your principal back. This makes them a good option for investors who are looking for a more predictable income stream. Now, the downside of bonds is that their returns are typically lower than stocks, but they can provide stability to your portfolio and help you sleep better at night, especially during times of market volatility. And hey, why did the bond go to school? To improve its interest. Ever wish you could combine the diversification of a mutual fund with the flexibility of trading individual stocks? Well, guess what? You can. Enter ETFs or exchange-traded funds. ETFs are essentially like mutual funds that trade on stock exchanges. They track a specific index, sector, or asset class, just like mutual funds, but you can buy and sell them throughout the trading day, just like individual stocks. This means you can get instant diversification across a basket of assets while still having the control to buy and sell whenever you want. ETFs are also known for having lower fees than traditional mutual funds, which is always a plus in my book. And because they track specific indexes, they tend to be more tax efficient than actively managed mutual funds. So, if you're looking for a low-cost, flexible and diversified way to invest in the market, ETFs are definitely worth checking out. And remember, ETFs are like the cool kids of the investment world, always flexible, always diversified, and always ready to trade. Okay, let's talk about the elephant in the room, or maybe the Bitcoin in the blockchain, cryptocurrencies. Now, I'm not going to sugarcoat it. Crypto is risky, like really risky, but it also has the potential for massive rewards. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They're decentralized, meaning they're not controlled by any government or financial institution. This has made them incredibly popular with tech enthusiasts and investors looking for an alternative to traditional financial systems. Now, the value of cryptocurrencies can fluctuate wildly, like seriously wildly. One day you could be up 100%, the next day down 50%. It's not for the faint of heart. But if you're willing to stomach the volatility and do your research, crypto could offer the potential for significant returns. Just remember, never invest more than you can afford to lose. And if you ever feel like you're on a roller coaster, you probably are. Remember what I said about keeping things simple? Well, index funds are the epitome of simplicity when it comes to investing. They're basically the set it and forget it option of the investment world. An index fund is a type of mutual fund or ETF that tracks a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Instead of trying to beat the market, index funds aim to match the market's performance. The beauty of index funds is that they're incredibly low cost and require minimal effort on your part. You don't need to research individual stocks or pay high management fees. You simply invest in the index fund and let it ride. So, if you're looking for a simple, low-cost and effective way to invest in the stock market, index funds are the way to go. And hey, why did the index fund break up with the individual stock? It couldn't handle the drama. All right, let's be real. High-yield savings accounts aren't going to make you rich overnight, but they're a great way to earn a little extra something on your money while keeping it safe and accessible. Traditional savings accounts offered by big banks typically pay next to nothing in interest. High-yield savings accounts, on the other hand, offer significantly higher interest rates, often 20 to 25 times higher than traditional savings accounts. Even if you're not earning double-digit returns, a high-yield savings account is a great place to park your emergency fund, your short-term savings goals, or any money you might need to access quickly. Plus, with the Federal Reserve raising interest rates, now is a great time to shop around for a high-yield savings account that can help you earn a little extra on your cash. Every dollar counts. You know what they say? Why did the high-yield savings account go to therapy? It had too many interest issues. So consider a high-yield savings account for your short-term financial needs. Ever wanted to be the bank and lend money to borrowers? Well, now you can with peer-to-peer lending platforms. These platforms connect borrowers directly with investors, cutting out the traditional financial middleman. As an investor, you can browse through loan listings and choose which borrowers you want to lend money to. You can set your own interest rates and loan terms, giving you more control over your investments. Now, peer-to-peer lending does come with risks. Borrowers can default on their loans, and there's always the possibility of fraud. However, many platforms offer some level of investor protection, and you can diversify your investments across multiple borrowers to mitigate risk. If you're looking for a way to earn potentially higher returns than traditional investments while helping people access credit, peer-to-peer lending might be worth exploring too. And hey, if you ever wanted to tell someone, "I'm not a bank, but I play one on the internet," now's your chance. Last but not least, let's talk about commodities. These are the raw materials that make the world go round, things like gold, silver, oil, natural gas, and agricultural products. Investing in commodities can be a good way to diversify your portfolio and potentially hedge against inflation. Now, commodity prices can be volatile, just like stocks and cryptocurrencies. They're influenced by factors like supply and demand, global events, and even the weather. You can invest in commodities in a few different ways. You can buy physical commodities like gold bars or barrels of oil, but that can be expensive and impractical. A simpler way to invest in commodities is through ETFs or mutual funds that track commodity indexes. So if you're looking for a way to diversify your portfolio and potentially hedge against inflation, commodities are worth considering. And remember, investing in commodities is like having a backup plan for your backup plan. Just don't try to pay for your coffee with a gold bar. There you have it. The top 10 investments to make money in 2025. Remember, the best investments for you will depend on your individual financial goals, risk tolerance, and time horizon. Do your research, start small, and diversify your investments. And don't be afraid to seek professional advice from a financial advisor if you need it. Investing is a journey, not a sprint. So get out there, start investing, and watch your wealth grow. And remember, if you ever feel overwhelmed, just think of investing as planting a money tree. It might take time to grow, but the shade will be worth it.